As more companies are private and grow and provide the entrepreneurial zest that the economy needs, those companies are private, and they're financed with private equity and private debt. So the long-term trend here, or the medium-term trend, is very positive for growth. Meanwhile, investors want safety. They want stable returns. By stable returns, I'm not talking about fluctuating price-driven returns, like is the price up today or is the price down today, but a cash return, a cash stream, like an old-fashioned savings account that once existed, a passbook savings account, or a so-called Ma Bell bond, a AAA bond issued by a once now non-existent telephone monopoly.
Yeah, well, one challenge, though, that I hear from investors with CLOs is that they invest in broadly syndicated loans for the most part, other than middle market CLOs. But for the most part,
yes,
that's what it refers to. And that universe has not been expanding. And last year, actually, you saw a little bit of contraction as an increasing amount went to the direct lending market, that these markets aren't necessarily conflated in the same way. How does that pose a challenge or an opportunity to you?
Well, two things. The broadly syndicated loan market in recent years has been mainly driven by refinancing as opposed to new borrowers, new transactions, new LBOs. And as we know, there's just a titanic amount of unspent, raised but uncalled private equity capital. And as I mentioned, the part of the economy that's growing is the private side and the entrepreneurial side. If you actually step back, we actually have. Another question would be like, are we going to have a recession? What would that look like, and what would drive it?
You're trying to get ahead of that one.
But we have kind of rolling recessions in different industry segments. But the economy overall is strong enough that you don't necessarily see it unless you're zeroing in on retail or energy or something like that. But back to your question about growth, we see that there's strong underpinnings for continued growth, and especially if private equity starts deploying their capital. The most efficient and effective way to do that with leverage is, of course, with broadly syndicated loans. They're the safest form of private debt because these are the larger companies. It's highly transparent, and there's liquidity. Direct lending is interesting. It's been growing, and of course, what we really mainly hear about it is, hey, banks have pulled back and we're replacing them. So it's, in that sense, clearly, well, it's not completely new. It's an untested as a broad asset class. It's certainly changed.
And you sound skeptical.
Well, let me just say this. Everything needs to have an appropriate risk-adjusted return. Some investors can just tolerate more risk, and you can create products with a higher risk profile that are appropriate for them. The question I have is, to me, private lending looks like their spreads are too tight. They appear to not either have a sufficient credit premium for lending to much smaller, riskier companies, or a premium for liquidity because these loans are illiquid.
So you think that it could potentially underperform in the years to come?
Yes, I think there's not enough risk-adjusted return, in my opinion.
All right, so.
But I don't want to just add quickly, Lisa, that it's not a case of one size fits all. You have to look at each borrower and loan case by case, one at a time. So we have to be careful with these broad generalizations. But I'll generalize to say, as a new asset class, it seems like it's just priced right on top of broadly syndicated loans, which to me seems inappropriate.